what institutional trading is when banks, hedge funds, or mutual funds decide to trade inside the market and basically move the market as well. When you're trading stocks, it's not just you and millions of other people trading these stocks, it's also banks, hedge funds, mutual funds, and investors that have a very large amount of capital. Remember, retail traders, which is basically what we are, we only might place trades a few $1,000s, but institutions are moving millions or even billions of dollars inside one single session, meaning within one single day or one single week, they're moving billions of dollars around. And how do they get into their trades? So they have to use a specific strategy because let's say market's down here and they don't want to explode price out of nowhere. They need to slowly fill in their orders, but they need to fill in their orders in points that they know they can fill in their orders. And those are those liquidity zones. When we get to mark out these highs and lows that we constantly keep seeing rejected and we can have these liquidity zones ready, we know that when market pulls back down into these zones, it's most likely market makers, banks, hedge funds getting ready to enter their position. And another perfect way we can always find these liquidity zones is by fair value gaps. If you don't know what fair value gaps are, I highly suggest you continue watching this video. If you already know, skip around a minute of this video. Fair value gaps are a little bit different than liquidity zones because fair value gaps are a three candlestick pattern. When we create three candlesticks going in a certain direction, or not necessarily having to go in a certain direction, but when we create this three candlestick pattern, what we're looking for is a void of inefficiency. What I mean by that is there any point in time where there was nothing but just a pure buying pressure or pure selling pressure if you're trying to catch puts? So here's a prime example of looking at it in both ways. When we're looking at this three candlestick pattern, you're normally going to want to look at the middle candle right here. And from there, we're going to be able to decipher if we're looking at a fair value gap or if we're just looking at candlesticks being pushed down. So I'm going to show you two examples and I'm going to show you why this one is a fair value gap and why this one isn't. The reason this one is a fair value gap is because when we created this three candlestick pattern, we actually ended up leaving an inefficiency of orders right here in between this wick and this wick. When we create that inefficiency between these two wicks, it basically means that this entire little push up between right here between wick to wick was nothing but calling orders. So right there, that means that's a gap and we can see price pull back down and allow us to enter because this is where banks are entering. Banks need a point of liquidity that they can enter their orders on. So when they're able to pull it back down into a fair value gap, that allows them to fill in their entries and be able to finally move the market where they want to. And it's the exact same thing vice versa. But this one isn't a fair value gap because you can see here that these wicks are overlapping completely this second candle. And this second candle is the most important candle in a fair value gap. So because they're overlapping it completely, there is no fair value gap. But if this was maybe not here, then you would mark out this entire point. This entire point was nothing but an inefficiency of pure puts. So this would be a fair value gap that we would want to see price come back into and then reject off of. Fair value gaps are pretty simple. Now going back to how you're able to trade off of them, once you're able to mark out where your liquidity zones are, you're able to know what price is going to range around in. Once we know that price will range around these liquidity zones, we then need to figure out where do banks want to place their orders. So let's say they're looking for calls, where exactly do they want to place their orders? They might have already placed their orders here and they entered for calls and they already pushed the market up. But knowing banks, they're extremely greedy and they want to make as much money as possible by any means necessary. So what that means is that they're going to have to eventually come back down to fill themselves up again to be able to go up again. And that's exactly where we can mark at our fair value gap, get our trade entry, and be able to the second we tap and we're showing volume displacement, if you're able to get another tap, that's perfect, and that is your entry to enter for calls. And it's the exact same thing vice versa. I hope you guys understand what institutional trading is and how you're able to trade just like them. If you have any questions, send them to me in my Discord or comment in the YouTube video. Later, guys.